So we're a couple chapters in here. Back in chapter 2, we learned a little bit about the time value of money and how we can do basic financial calculations. Chapter 3, we got a taste of taxes. And here in chapter 4, we're going to again uncover one of the main ideas in personal finance, which is stock investing. We're not going to get everything we need out of just this one chapter, but it's going to give us a decent start. So starting at the ground level here, we need to have a general understanding of what stocks are. Now, this is personal finance. This isn't, a class where we're trying to learn how to become financial engineers or have a finance career. It's about empowering ourselves to manage our money. So we don't need to know tons of details, but we do need to know a little bit about what stocks are, just so we know what we're investing in. Stocks are pretty simple, though. They just are simply ownership in a company. And they are a result of businesses needing to raise capital to try to expand. So, for example, if I'm starting a new business, let's say I'm going to start some sort of computing software business and I need $10 million to begin, one way to get that money would be to borrow. So I could borrow $10 million from various sources. That's called debt financing. And if I borrow money, I will be selling bonds onto the market. So when you invest in bonds, you're just essentially buying debt from companies. When you invest in stocks, on the other hand, you're actually buying a piece of that company. So if I needed to raise $10 million, I might decide that I'm going to sell 10 shares of my company at $1 million a piece, and people who buy those shares get a chunk of my company. That's what stocks are. Most of the stocks that are traded now on the market are pre-existing chunks of these companies. So if I go invest in McDonald's stock, it's not like I'm buying a piece of McDonald's from McDonald's. It's not like I'm actually giving money to the company. Rather, I'm buying shares of that company from another investor who bought those shares from another investor, and so forth, and so forth, and so forth. So there's money changing hands from person to person. And these stocks provide value in two ways. One, the stock prices tend to go up. There's a lot of volatility from a company-to-company standpoint. So if you invest in one company, there's not that small of a chance that it could go to zero. If you invest in just one firm, it may not go up in price. But usually investing means investing in lots of different firms. That's usually the smart way to invest from a personal financial standpoint. So on average, if I invest in thousands of different companies, those companies on average will go up in value. So by holding the stock, I get to enjoy the fact that the prices go up over time. Additionally, stocks also pay out dividends. Dividend payouts are simply leftover profits that a firm has. So if McDonald's makes $100 million in extra profit this year, it's got money that it doesn't necessarily have a need for. So what it could do is distribute that money out to its shareholders. Maybe every person that owns a share gets 2 cents per share in profit. The way this looks in an account is if you have a regular investing account, one day you'd log in and find that there's some cash in your account. All right, it's no longer invested, it's just cash that was paid out via a dividend. If we look at these two values provided to us in combination, we can expect about a 10% return, as we discussed in previous videos. If we look back over the last several decades of investing in the U.S. stock market, the market has returned about 10%, just a hair above that historically. The majority of that comes from stock prices going up, and dividends make up a relatively small share, and in fact are becoming less important over time. So if you're an investor and you buy into stocks, you need to recognize that most of the value comes from the expected increases in the stock price through time. Now let's put some numbers to these stocks and think about trying to categorize companies into different groupings. So for example, let's look at the company Electronic Arts. The company that makes video games, EA. Electronic Arts has a share price as of the time that I'm writing this of $138.26. So that's how much an individual share costs you, the investor. So you could buy one share, you could buy 10 shares. Some platforms even allow you to buy a fraction of a share. So you could buy 10% of a share of this company. So that's how much each share is worth. And frankly, that number doesn't mean much. Just as an example, let's compare that to Intel, the information and computing firm. Intel has a share price of only $32.02. Now, people who really don't know anything about the stock market might look at these valuations and think that it tells us a lot about these firms. They might look at this and say, well, the share price of EA is about 4 times the share price of Intel, so maybe EA is 4 times larger than Intel. That's not the case. This is really quite arbitrary what these prices are. Going back to my example, if I started up my own business and needed to raise $10 million, I could issue 10 shares. Each of those shares would be worth about $1 million. Or I could issue 1,000 shares. Now, if I issue 1,000 shares, each of those shares would be worth $10,000. If I issue 10 million shares, each share would be worth $1. So effectively, if you're a firm that's issuing stock, you can take that pizza and slice it up as many times as you want. The more times you slice it up, the smaller each share becomes relative to the overall pie, and the less it is worth. And that's exactly what's happening here. Intel, for whatever reason, decided to cut its pizza, its firm, into more slices when it was issuing stock, and so the share price is relatively low. So if we really want to understand how big a firm is, we shouldn't look at its share price. Instead, we need to think about what's going on with something called market cap. Okay? So to get to market cap from a mathematical standpoint, we would need to know the shares outstanding. Shares outstanding is another key term that's in the book, freefinancebook.com. And it basically just tells us how many shares exist. It's just the number of shares that are out there on the market. And so these are not exactly correct numbers, but EA has about 265 million shares outstanding, while Intel has over 4 billion. And this explains, again, why the share price for Intel is so much lower. It's chopped into more pieces. So if we want to get an idea of how big a firm is, we need to solve for its market cap. And I say we need to solve for it. Really, we can find this information online. We don't need to do the computation from a practical standpoint. But if you're taking my class, I often ask students to solve for market cap just to make sure they understand where the value comes from. Market cap, real easy, which stands for market capitalization rate, if I wanted to write it all the way out, is simply the share price multiplied by the number of shares outstanding. So if we were to solve for the market cap for EA, we would simply multiply these together and we would find a market cap of about $36.7 billion, which is a lot. This is a big firm, okay? In fact, we would categorize this a large cap, which means it's a pretty big company. One of the biggest companies in the world, really, if you think about it, one of the, I think, the 1,000 largest. So this is a very large company, and the interpretation here is if all of the shares of the stock right now could somehow be just immediately liquidated, just immediately sold, this is how much they would be worth. So if we were to ask ourselves, how much is EA worth? One good answer for that would be its market cap. As we'll learn as we go through this material, though, there's other ways to think about what a company would be worth. And when it comes to stocks, this valuation is based on expected future profits, not current profits. So a company like EA, maybe it's not that profitable today. Companies like Uber, Tesla, NVIDIA. These companies aren't all that profitable now, but people expect those companies to be more profitable in the future. So those companies have very large market caps based on the anticipation that people want to invest in them today because they expect that company to have a lot of profit in its future. So market cap doesn't necessarily tell us profits now, revenues now, anything like that. It merely is an indication of what the investors think this company will eventually be worth. So investors really think that EA is going to be worth a lot of money in the future. But not as much as Intel. Intel has an even larger market cap. So again, we can solve for market cap by merely multiplying these together, and what you would get is a market cap of about $136 billion. And you can see why these prices really belie the truth of what's happening here. Intel is a much bigger company, and these share prices really don't tell us anything important. They're just numbers that show you how much they cost to buy a piece. They don't tell you anything else. So we can then think about market caps to put some labels on different firms. And there's lots of ways to categorize firms, but some common ways to do so would be to divide them up into three categories: the large caps, the mid caps, and the small caps. Large cap firms are the really big ones, usually based on a market cap that exceeds $10 billion. So these are the big boys. In the United States, we have about 600 large caps. Now that number is going to change over time, and so too probably will the categorizations. Eventually we might say a large cap has to be at least 20 billion or 100 billion. And hell, there's no exact definition now. But it is useful to have some sort of cutoff point when we think about investing. Because when you look in your 401k offerings, you might see some investments that contain only large cap stocks or only small cap stocks. Understanding what those are going to help you make better financial decisions. Mid caps are when the shares, or rather the market cap, is between 2 billion and 10 billion, so that kind of in-between category there. And then the small caps are for market caps that are less than $2 billion in value. And there is, believe it or not, if you think about it, probably would make sense, some differences in expected returns if you invest in these. So let's quiz yourself here a little bit. On average, which of these categories do you think has higher expected returns? Large caps, mid caps, or small caps? Well, it turns out that large caps have the lowest historical returns. And the logic of that is that these companies are generally more stable. They're less risky. So as an investor, I might be willing to invest in large caps even though they generate a slightly smaller expected return because I prefer to have less risk. Or to put it another way, if I'm going to invest in small caps, which are riskier, I need to be compensated for that extra risk. So if we look back at historical data, the mid caps and small caps in aggregate have outperformed the large caps, and we think that's probably because of the extra risk that comes from investing in these smaller firms. So as an investor, this is already some information that you might care about. If you're young, you might say, perhaps hold a little bit more small and mid caps than other people would. The extra return you generate isn't that large, but at least there's a logic there to your investing choice. Just yesterday, I actually had a student reach out, and he was working on his 401k package. He just signed on with a new company. He's got a really good job, and he was trying to decide what to invest in. And when he looked at his investing options, there were some good large cap investing options, a good small one, but there was nothing in the mid cap range. And so I advised him, you're going to have to figure out a way to invest in some mid cap. So, when you're trying to build a really well-diversified, intelligent scheme, an investing scheme, a personal financial scheme, you want to make sure you have all of your bases covered. And understanding the differences in size here is just a small piece in that much larger puzzle. So, thinking about those categorizations, many years ago, there were people that tried to figure out how much the stock market as a whole was worth. And one of those first methods of doing so led to the Dow Jones Industrial Average. You probably heard of the Dow. The Dow Jones Industrial Average is one of the most popular stock market indexes. Stock market index attempts to gauge the performance of a market or an industry or something else specific like that. When we think of the Dow Jones Industrial Average, really the goal here would be to figure out how is the U.S. stock market performing overall. Now, this Dow was created a long time ago and there wasn't that much sophistication then, and so the Dow Jones Industrial Average is based on one share of the 30 largest U.S. stocks, or really I should say U.S. corporations. Now, at the time, this was a nice, simple way to think about building an index. Just what if we just bought one share of the 30 largest firms, which would perform the best? But nowadays, we might look at something like this and recognize this is really a stupid way to think about the performance of the market. And what makes this particularly stupid is it's based on the price of the firms. Price, as we showed before, is really quite arbitrary. So this is an index that is price weighted, which means that a firm's size in the index is based on the share price. This means that firms that have a very high share price are going to be arbitrarily important in the index. So for example, in the Dow Jones Industrial Average, I think Boeing is one of those 30 firms, or at least they were before their issues that happened recently. One of the 30 largest firms, Boeing, had a very high share price, despite the fact that it is one of the smallest firms in the Dow Jones Industrial Average. So it had a high share price despite being really small. This meant that Boeing was playing an arbitrarily large role in that index. So if Boeing went up 5% in a given day, the whole index would likely go up just because of that move. That's silly, all right? Boeing is a pretty small part of our overall economy. We should care a lot more when a company like Microsoft's share changes because it is a much more valuable company that has a lot more assets and a lot more. So today, most indexes, particularly the ones you can invest in, are value weighted, okay? And the one that gets the most popular press, and probably rightfully so, is the S&P 500, the Standard & Poor's 500 index. The S&P 500 contains the 500 biggest companies. Or really, I should say the 500 largest U.S. corporations. These are all just domestic here that we're talking about. So it contains the 500 largest U.S. corporations, and it bases its index on market cap, not on price. Okay? So this is a value weighted index. So what that means is if Microsoft is 20 times larger than Intel, then Microsoft will be 20 times more important, 20 times more heavily weighted in that index. In the Dow Jones Industrial Average, market cap doesn't matter. It's based on price. So if Intel is twice as expensive as Microsoft on a price basis, it will also be twice as important in that index. So the S&P 500, which is really just a collection of large caps, is a really good way to measure the value of the U.S. stock market. It's not perfect, but it's pretty good because these 500 largest U.S. corporations represent, I think it's something like 85 to 90% of the overall U.S. stock market because these firms are just so large. And you can invest in these, okay? So one of the most common ways to invest in stocks nowadays is to buy an S&P 500 index fund. An index fund, which we will talk a lot about in this class, is merely an investable fund that contains what the index is tracking. So if you invest in an S&P 500 index fund, essentially what you're doing is you're just buying the S&P 500, which is a smart way to invest. It's pretty well diversified, contains a lot of different stocks, and if you want to go broader than that, you can invest in something that's even larger. You can invest in a total stock market index fund. And that would include every single stock available in the United States on a price-weighted basis. So you can effectively buy the entire U.S. stock market in just one click. It's hard to get much more diversified than that. So these are funds that we're going to spend a lot more time talking about in the future, and you can see why we needed to discuss these other topics before getting there. To understand what the S&P 500 index fund is, you need to understand the S&P 500. To understand the S&P 500, you need to have a grip on large cap, mid cap, and small cap, which means you need to understand about shares outstanding, share price. These are all really important features. So that concludes chapter 4. Check out my book, Free